Welcome to Bloomberg ETF IQ. I'm Scarlett Fu. Katie Greifeld is off for the day. Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. Bitcoin nears $121,000 for the first time as the U.S. House of Representatives start considering industry regulation during its crypto week. And in just a moment, we'll be speaking with Sylvia Jablonski of Defiance and talk with her about the seemingly unstoppable rise of leveraged ETFs. And later in the program, Graham Day of Innovator joins us to discuss the first ever dual directional ETF, the latest development in the defined outcome space. But as always, we have Eric Balchunas from Bloomberg Intelligence with us, and he is looking at the flows. Eric, what did they show us?
Scarlett, you talked about it all. So the flows are looking a lot like 2024. And the big theme that year was beta with the side of Bitcoin. And look, beta, that's, equity beta, VU, you can't get more beta than that. And Bitcoin. SPLG is also, it's the S&P 500 mini-me of SPY. It's cheaper version. So you got beta there. Money into junk bonds. Interesting. Haven't seen a junk bond ETF up here this high. USHY, the cheapest junk bond ETF, or one of the cheapest, and now the biggest, believe it or not, bigger than HYG. A little bit into utilities. Maybe that's a bet on the rates coming down. And then Ether. I mean, you haven't seen an Ether ETF up here with the big dogs ever. So the Ether people, very excited about that. Let's look at the outflows here. And you're going to see that there was a little bit out of the diamonds, a little bit out of the Qs. That's very 1990s speak of me. XLV, IVV, so a little bit out of some of these equity ETFs. But if you look back in the past month, there's been $91 billion into equity ETFs. So very bullish. I think we're well past the tariff tantrum into a comfortably bullish state of mind here. Let's hone in on the Bitcoin and Ether for a minute here. And since the rally has been all the news today, it's showing in the flows. I think the ETFs have been part of the rally. If you look, this shows the spot Bitcoin ETFs, and here's the spot Ether. So Ether's smaller, but definitely it's trending up. But look at the Bitcoin ETFs. They've taken in $50 billion since they came out. So they came out in January. They had 28 because GBTC was a conversion. Now all the way up there, $155 billion in assets. IBIT more than half, now the 20th biggest ETF overall, 7th biggest for BlackRock, and most profitable for BlackRock. So 300% return since the ETF was filed 2 years ago, Scarlett, and boom, what an explosion of growth.
Yeah, that chart really shows it all. Eric, thank you so much. Joining our conversation now is Sylvia Jablonski. She is CEO and CIO at Defiance ETFs. And we'll talk about leveraged single stock ETFs in a moment. But I wanted to start with what Eric mentioned, which is beta with a side of Bitcoin. How often does Bitcoin and crypto come up in your conversations with clients?
So almost always. And I think that that's the new investment style. Like if 60-40 used to be the standard go-to, I think it's 60 plus something plus some little spice of Bitcoin is just now become the average asset allocator's rule book.
Let's talk about you don't have a Bitcoin or spot Bitcoin, but you do have the double leverage micro strategy.
Yes.
Which is, talk about hot sauce. That's right up there.
Yes.
That thing is one of your best sellers. What's that like? First of all, do you talk to Michael Saylor about it? Is he into it? How much interest is there in that? That's sort of like another. I mean, I always thought the 2x MicroStrategy was really like a 4x Bitcoin.
Yes.
Right? So it's a backdoor way to get a lot of leverage on Bitcoin.
Yes, so you're absolutely right. If you look at the historical performance of Bitcoin and you overlay that with MSTR, you can kind of see that MSTR itself trades like a leveraged version of Bitcoin. Now throw some leverage on there and you're getting that additional level of amplification, as you call it, hot sauce, to the stock. And so, I think people like Michael Saylor probably like that investors are embracing crypto and Bitcoin and MicroStrategy related products, you would think, right? To what you said, we actually have two of these spicy products. We have MST and MSTX. You have one product that has exposure to MicroStrategy plus an options overlay that gives you income, and then the other is just a straight 2x leveraged. And yes, short-term tactical traders who are looking for exposure to Bitcoin are absolutely pouring into this and using it, tactically to get that price appreciation in the short term.
As Eric reminds us, these are hot sauce. They're not buy and hold products. They're things you trade into and out of in minutes, and certainly just for a day at the most.
Yeah.
What can you tell us about the traders and the investors who are using these products? Do they keep coming back day after day, or do they rotate among a group of names? What's their, give us a sense of their behavior.
Yeah, so I think if you look at just generally single name levered ETFs and levered ETFs in general, if you have a levered ETF on a sector that is just absolutely non-volatile and you're leveraging it up, some investors may review that position every day, understand that there's a daily risk, but they may hold it for a little bit longer because the volatility is not as, kind of erosive as a product that is highly volatile. And so we see traders embracing this in the correct way, right? They're day trading these products. They're looking at them in the short term. They're looking for amplified exposure for a period of time, whether it's around earnings or for some sort of, news bit, or they think that volatility and direction will play in their favor. They put on the position, they monitor it, and, they kind of understand that this isn't a set it and forget it in your portfolio at this stage.
So most of these double leveraged equity ETFs are up a lot because the market's been rallying and usually pick stuff that has a lot of voltage, like quantum computing stocks. But there is one that is an interesting case study, Defiance 2X long HIMS ETF, which is the Hims and Her Health. Some people were like, I cannot believe they've 2X that. But anyway, that had a bad moment, and the ETF went down 68% in a day.
Yes.
Let's just be honest here. It didn't liquidate, but what would have to happen for one of these to sort of like terminate XIV style?
Yeah, so I think, with XIV was a debt instrument, essentially. It wasn't an ETF traded in the secondary market, right? Like you had the credit backing of Credit Suisse, and if they could no longer provide exposure, it starts trading like a closed-end fund. With ETFs, there's all sorts of things you can do. So for example, if there's a outsized move in the market, you could trigger an intraday reset if you had to. But the biggest thing I would say, just for all ETF issuers, is when we know that there's going to be a big move and it's possible that you cannot get the leverage exposure that you seek, two things. Number one, in the prospectus, we always say up to. We seek up to 2x. There may be times where we cannot in the event of a market crash or things like this. And the second thing is just disclosure. Today, this is where we're at. This is the beta. The stock has moved this much. So it's disclosure of information. The fund, didn't get wiped out with that big move, right? It was managed just in that way. We had that transparency, and then we had it, necessarily had it laid out in the prospectus about the leverage point.
And once it recovered, I'm not saying recovered to where it was before, but it did stabilize at least.
Right.
What kind of volume, what kind of flows did you see in terms of behavior from investors who were piling into up until that point?
The biggest inflows of HIMS were on that day. On that day.
These degens, they love nothing more than going in the opposite of what just happened. So that's why during the tariff tantrum, when the markets were falling, there was record flow into the leverage longs, right?
Yes. And actually, in my career in levered ETFs, which has been a pretty long one at this point, it has always been that way. When the market pulls back and you have levered and inverse ETFs, it's the inverse ETF tends to be a static hedge that a lot of these traders use, but the bull funds tend to be what they're pouring into as the market is crashing, which if you think about it, the degens are actually doing it the right way, right? The problem with the markets is a lot of times the stocks are going higher and higher and higher. Retail buys high, right? And then they crash and they're selling their positions. In this case, I think that they are aware that, hey, this name has pulled back, it's a levered ETF. The potential move on the next day could be upward, and I can amplify my position and benefit from that.
They're increasingly driving market activity, these degen investors that Eric likes to talk about and write about constantly. How big is this specific investor pool of degen investors, and how big of a part of your investor base are they?
Yes, well, I would like to call them wise versus degen, but this is a massive pool. I think that this is really, you and I were talking about this off camera, Scarlett. I think post-COVID, when you had this world of short-term trading and AMC was in the news and Bed Bath & Beyond were in the news, you had this group of investors that came out. A lot of them were young people, a lot of them were professional day traders, and they really started talking a lot about it on X, on YouTube, on all sorts of social media. Discord, and I think the news got out, the platforms made it easier to trade, and now you have this whole community of people who got into the market, got the bug, and are now very much rulers of the market in a way.
Yeah, no, it's a huge audience. You're lucky in that you don't have to deal with BlackRock or Vanguard, right? You operate in a separate world, and that must be nice. However, you got Tuttle, the infamous Matt Tuttle, and you've got Granite shares.
Yes.
How much is the competition a factor for you in in terms of product development and marketing now?
Yeah, I mean, the competition is absolutely fierce, but we would like to think that ourselves, Will Ryan, Matt Tuttle, you know, these ETF firms that are our big competitors, maybe we're the next BlackRock, State Streets, and Vanguards of the world, right? I think that there's plenty of room in this market for innovation, and we all have different types of products that we have brought to market and have had success in those products. But of course, right, we're in competition, and everybody's trying to come out with the next best idea, and you know, we'll continue to try to dominate.
Yeah, growing from your very own corner, right,
Yes.
of this world. Thank you so much,
Thank
Sylvia.
you.
Always a pleasure.
Thanks.
Sylvia Jablonski of Defiance ETFs. Coming up on ETF IQ, we were just speaking about leveraged ETFs. There's also the first ever leveraged CLO ETF. This new fund has sparked criticism from the manager of the largest CLO ETF, John Kirshner, at Janus Henderson, who says this fund should not be for retail investors.
We just worry about investors buying something like this, and then, you know, when we get another dislocation, that the drawdown is more than they wanted. As far as we're concerned at Janus Henderson, for our clients, you want institutional investors who want higher returns or more leverage. That's more appropriate than a retail investor for this product.
Welcome back to Bloomberg ETF IQ. I'm Scarlett Fu. It's time for the ETF Brief, where we highlight stories and trends that caught our eye. And we're going to start with the Reckoner Leveraged AAA CLO ETF. Ticker RAAA is the first fund to invest in a variety of top-rated CLO bonds while leveraging up to 50% of that exposure. The fund marries two trends: strong demand for CLOs, which bundle buyout debt into bonds, as well as the popularity of leveraged products. Next, Vanguard's unintended exposure to Bitcoin. The firm has long held firm that Bitcoin has no inherent economic value, is an immature asset class, and is not appropriate for long-term investors. Yet, Vanguard is now the single biggest shareholder of Strategy, as you can see here, Michael Saylor's software firm that's become a proxy for Bitcoin. Vanguard owns 20 million shares, and the reason? Index investing. Vanguard mutual funds and ETFs that passively track indexes have no choice but to end up holding shares of Strategy, even though the firm dislikes Bitcoin. Irony, clearly. And I want to end on leveraged single stock ETFs that we were just discussing a moment ago. These assets have exploded in the last year and a half. Bloomberg Intelligence estimates that if you include long, short, and covered call funds, these products now command north of $38 billion and counting. A record 73 leveraged or inverse ETFs launched in the U.S. last year, more than the two prior years combined, and over half were single stock. This year has already exceeded that, with more than 100 leveraged or inverse products overall, and of that, 3/4 are single stock. So let's talk more about leveraged single stock ETFs with Bloomberg News cross-asset reporter Emily Graffeo. Your latest story is the big take here at Bloomberg. And I guess I want to start with this idea that you went to visit one of the leading issuers of leveraged single stock ETFs, Matt Tuttle. What did you learn? What was interesting?
So what immediately stood out to Vildana Hayek and I, we worked on the story together, was that his setup, it didn't look like just a typical trader who has a couple monitors. He had the monitors, you know, looking at markets, the Bloomberg terminal, but he also had a couple screens that were set up, and he was using Discord, or he was monitoring retail traders and investors talking on these platforms about what stocks they liked, what they thought was ripe for a squeeze, what was going to go up, what was going to go down in value over the next few days. And he told us that this is where he gets some ideas. These products are pretty retail focused. I mean, we do know that there are likely some hedge funds that use them as well, but they are also for retail. So he gets ideas from looking and seeing, like, what is the buzz? What can I kind of create a product that people are going to like?
And, you know, is he communicating with these people? Because he told me, you know, back in the day, I'm just making stuff that I would trade. Mm-hmm. He's definitely not a Vanguardian 60-40 person at all.
Right.
So he is walking the walk of who he is. So it's almost like a degen creating degen products makes sense, right?
Yeah. And of course, I mean, and Sylvia was just saying, like, she wouldn't use the term degen. Mm-hmm. And I don't know if Tuttle would either, nor Will Ryan of Granite Shares. They really had this idea of, like, these traders are smarter than we think, just because they're not traders at Vanguard, just because they're retail, maybe they are sitting at home trading ETFs in their basement. They're doing research. They are online. They are communicating these ideas. So I think Will Ryan was the one who said we can't be falling into this trap of thinking that retail investors are not as smart as we think. But yeah, Tuttle, I mean, he is monitoring it pretty closely to get ideas.
One of the what really blew me away is one of the quantum computing single 2x ETFs, QBTX. It's traded 1.5 billion since launching, and 3 months ago, it only has 40 million. That ratio is ridiculous. 40 million in assets to 1.5 billion in trading. So definitely, they're not making a ton of money because a lot of the volume is in assets, but it definitely it gets to assets a little bit.
Yeah, and if you do the math, if you just multiply, like, what is the expense ratio of the products that these issuers have times the assets, of course, you have to kind of keep that number steady. It varies as the assets fluctuate throughout the year. But these products are more expensive than what other issuers are doing. This is certainly a way that these issuers are making money. If you're a startup ETF, you're not going to be competing with BlackRock and Vanguard on passive. You got to kind of go out on the risk spectrum.
Yeah, we used to talk about the race to zero. This is anything but 1.3% for QBTX.
Yeah, no, this is the race to adrenaline.
All right, and it costs you. Emily Graffeo, always a pleasure. Thank you so much. Bloomberg News cross-asset reporter Emily Graffeo. Still ahead, we're going to drill down into the first dual-directional ETFs with Graham Day of Innovator Capital Management next. And a reminder, listen to Eric and Joel Weber on, what's the name of your podcast?
Trillions.
Trillions. It's their podcast that covers the industry. It should be called Tens of Trillions at this point.
I know. Quadrillions is the next title.
All right, there you go. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu. It's time for today's drill down, where we focus on two new ETFs. Eric, what are they?
Scarlett, today we're looking at DTTL and DDFL, but we'll just do the T one today. This is the Innovator Equity Dual Direction 10 Buffer ETF. You've heard us talk about buffers on the show a lot. Booming business. Typically, you give up some upside to limit your downside. That's the basic thing of a buffer. And you basically are looking at a 79% expense ratio here. So you pay up for it, but you sleep at night because you limit your downside. That's why these are selling like hotcakes. 100 million into this early. Let's look at the holdings of this. And you can see this one is going to be a lot of options in here. So they just use options as a creative way to do that. But the dual direction, actually for the first 10% goes inverse the market. So you get a little positive return on the first 10% down, but you give up more upside too. Let's show the assets of buffer ETFs since they've come out, and you can see how popular they are since 21, really. 60 billion, Scarlett, again, because they do a lot of work and they help you sleep at night. There's definitely a demand for that.
Absolutely. All right, Eric, joining us now to talk about this particular ETF is Graham Day. He is CIO at Innovator Capital Management. Graham, good to speak with you. And I think Eric put it nicely when he said that these are targeted for people who can sleep at night so that they have some certainty around them. And they really took off in the aftermath of the pandemic. What does it say about the market environment and investor psychology that there's so much demand for buffer ETFs when the S&P 500 could be down 19% as it was in 2022 and also up 20-something% as it was in 23 and 24?
Well, Scarlett and Eric, it's great to see you guys. First off, what I would mention is Innovator, as you know, brought the first defined outcome ETFs to market back in 2018. We started with the buffer ETFs. And the reason why there's been so much interest in these products is because the vast majority of investors aren't looking to make their money twice. They are as interested in capital preservation as capital appreciation. And the dual direction are an extension of the buffer ETFs. And as Eric pointed out, these ETFs allow you to make money in negative equity markets. And so you can make money in both up markets and down markets. That's a first in the ETF industry. And the benefit is it's a defined outcome. So there's no hoping, there's no trusting that a bond strategy or private credit is going to do well in a negative market. You can know exactly which negative markets you can generate a positive return in.
And so, Graham, a lot of these buffers, I feel like, are aimed at maybe an older retail investor or advisor. But these new ones, these dual direction, you claim these are hedge fund killers. And I believe you to a degree, in that a market neutral hedge fund is going to be able to have return in any market environment. That's the goal anyway. And these are like that, just using sort of the buffer structure. Can you explain that? And maybe they'll appeal beyond older investors who want to preserve into maybe the institutional world.
Yeah, very much so, Eric. And you guys had earlier reported on endowments, institutions starting to look at buffer ETFs. And part of that strategy was to move away from these more expensive, illiquid, opaque hedge fund strategies. And I would maybe even lump in this surge into private credit as well, because investors are in those asset classes because they want to be hedged on the downside. They want to make some money on the upside. But what you lack is the certainty and the liquidity. And these ETFs give you the certainty, and they also give you the liquidity. And so very much so, in up markets, we want to capitalize. We want to generate a positive return up to a 12.59% cap for the DDTL, Eric, that you highlighted. But on the inverse, you can make that inverse positive return all the way up to that 10% level on DDTL.
Graham, where does this fit into someone's portfolio if they believe in the 60-40 allocation?
Well, there's a couple of areas that we're seeing advisors targeting. First is the alts bucket. And again, we're seeing more and more interest with stocks at all-time highs. Bonds, there's a tremendous amount of uncertainty. Are they going to be able to deliver in the future? But we're also seeing these ETFs being used as a hedged equity alternative. Again, when the markets are at all-time highs, you start seeing more investors maybe taking a more cautious approach to staying invested in the market. And now with these ETFs, if the market goes either way, an investor can make money.
And what about bonds? Let's say the Fed cuts rates and rates go down and bonds go up. I know these can challenge bonds. Would that make them more challenging of a sell?
I don't think so, Eric. And I think more and more investors are realizing that there's a tremendous amount of uncertainty with bonds. If we look at when the Fed cut rates 100 basis points last year, what happened to longer term bonds? The yields actually rose over 100 basis points. And we've started to see more of this change in long-term yields are trending higher. They're not trending lower. And so a cut in rates, it might benefit more in the short term of the bond yield curve, but the longer term, we could certainly see that move higher because the cut by the Fed would be another inflationary move, the rising deficits. There's a lot of headwinds facing bonds.
Graham, always a pleasure speaking with you. Graham Day of Innovator Capital Management. And of course, you can read about this drill down plus the latest in the ETF industry when you subscribe to Katie's weekly ETF IQ newsletter. That does it for this edition of ETF IQ.